So it's a very quickly evolving situation. I mean, once the virus got to U.S. soil, we saw a lot of businesses, pulling back on travel, people limiting their social interactions. Certainly the markets are reevaluating their forecasts. So it's a very rapidly developing situation. So things happen very quickly. And so the uncertainty around it was something that we took into account when we're thinking about the outlook going forward. Usually when you see the volatility in markets that we saw over the past week, right, what central banks do is they come in and make sure that there's enough funding so that there's an orderly functioning in the markets, and you assure that you are going to use your tools as appropriate. Yes.
Can I ask you then? I mean, it sounds to me like you were fully on board with the decision that was made. What was the debate around whether it was 25 or whether it was 50 like?
So when you're going to be doing this kind of action, you want it to be a decisive action. So 50 seemed like the reasonable thing to do, given what we see out there in terms of the uncertainty. This is a supply shock, a classic supply shock. Certainly lowering interest rates are not going to get people to start traveling again. Their social interactions are not going to be changed by a lower interest rate. But the supply shock can easily manifest itself into demand shock if uncertainty continues. And so I was fully on board with it to the, in the realm of, or the context of, this really could morph into something that could affect business, and consumer sentiment, and also investor sentiment. And so easing financial conditions seemed to be the right thing to do, given the tightening we had seen in financial conditions up to that point.
We were puzzling yesterday on how we describe this now, because we had a mid-cycle adjustment. So how do we describe this emergency move now and put this in context of the cycle for interest rates?
So remember, we always are willing and able to move rates when we think it's appropriate, and that's the way I would interpret what we did. We saw what was happening in the market. We always are looking at the outlook, and of course for the Fed, and for central banks, we look at the median run outlook, and the uncertainty around that outlook suggested that this was the appropriate move at the time.
But this could be a cutting cycle now.
Well, we go into every meeting, open-minded, especially when you have an evolving situation like this. So we don't prejudge, I'm certainly not prejudging when I go in 2 weeks in our meeting. We're all preparing our forecast. This will be our forecast round. 4 times a year, the Fed participants actually, do a new forecast, and we'll be releasing those.
The US economy, as Mr. Powell and you have been saying, is fundamentally still pretty strong. You've got maximum employment there or thereabouts as well. And that you do believe in the medium-term prospects for the US economy especially. Was this move done to A, calm the markets, or B, boost the economy, given what you've already just said to us about it will not solve supply issues?
Right. So it really is, in my interpretation of why I supported this, it's really looking at that medium run outlook. The risks around that outlook had gone up significantly. There's still a lot of uncertainty about the course of the virus and what impact it will have. We've already seen impacts in terms of travel, tourism. Businesses are cutting their travel, so we're going to see a reduction in activity, at least I think in the first half of the year. And so this was really in response to the economy and the outlook and the risks around the outlook.
So it wasn't about a market which had basically gone into freefall for several sessions and 1,000-point plus moves, stuff that even those of us who've been around a long while haven't seen very often.
Yeah, you certainly have to take note when the markets are doing that, right? Because you don't respond to market volatility per se, but if investors pull back as much as they were showing that they did, that also influences business sentiment and also consumer sentiment. And so there's a signaling in that market about the reevaluation of the outlook on the part of investors, consumers, and businesses.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.